You've closed nearly $25 billion worth of deals across 27 states, which is a mind-numbing number.
As a leasing guy, if you lease a building, you're conflicted from leasing a building across the street. As a capital markets guy, if you sell or finance a building, that's your calling card to sell or finance the building across the street. I provide capital solutions to owners and investors of real estate.
You had mentioned to me that you were at one point walking into buildings with floor plans and working down the building as leads. Why the comment that it's not as great for your loan career? Charles, it's a pleasure to have you here.
Hey man, thanks. Glad to be here.
So Charles Foschini, you've closed nearly $25 billion worth of deals across 27 states, which is a mind-numbing number. But I kind of want to take it all the way back to the beginning because I think you were closing deals before I was born.
Okay.
And a lot of people
probably true.
I was born in 93. And
okay.
When did you get into the business?
I came into the business in 85. And my first career was in leasing. I had a second career started in 98. So you were already in kindergarten.
There you go.
And that was when I started a capital markets career.
Got it. So out of curiosity, when you were born, was your family in the business? And when you were born, I am meant to be doing loans and buildings?
No, not at all.
Big loans and big buildings.
Big loans on big buildings. That's how I described my career to my daughter when she was small, and it became my hashtag on LinkedIn and other places. But I was a middle-class kid in New Jersey. My mom was a school teacher, retired to have my sister and I. My dad was a scientist at AT&T Bell Labs and the Google of its time. And education was very important to them. It was not important to me. I wanted to be like my grandparents that were in the trades, and I wanted to go to vocational school. And I was a good student, but a disinterested one. And I didn't see value in college the way my parents did. And so my dad told me I could apply to school anywhere in the country that they saved for me, and that would be their gift to me. And then after I was done with college, they could send me to vocational school. So being a 17-year-old kid that liked the outdoors, I was a lifeguard at the time as well. I applied to schools in California, Hawaii, and Florida. I got a scholarship to UM to study marine science. That's what brought me to Miami in 1983, well before you were born. I think your parents were born though. And, I studied marine science for about a year and a half, and I realized for me it was a much better hobby than career. Yeah. That's why I'm still tan. But it's not what I did as a profession. And so I switched majors to marine affairs, which UM had at the time. And I took a real estate class and just fell in love. And my professor at the time thought that, saw something in me that I didn't see in myself and asked me to apply for an internship at a firm that was then known as Coldwell Banker Commercial and ultimately became CBRE. And that's where I spent the better part of 30 years in two careers. First as a leasing career, and then by the time you were born as a capital markets guy.
That's wild. So when you graduated college, did you graduate with a degree in marine biology or had you
No,
switched?
I got a finance degree, and for a kid that didn't want to go to college, I realized that I didn't know enough to know anything. So I applied for an MBA, and UM offered me a fellowship to study my MBA.
Good.
And I got an MBA while I worked. I worked for the university. I had my own business tutoring. And my internship at Coldwell Banker had worked out so well that when that firm was privately held long ago, pre-HR, I would say.
Yeah.
I worked for a lot of individual brokers and just did odds and ends, whatever they needed, whether it was paying their house or stuffing envelopes, which is how you got people to know who you were before LinkedIn.
Yeah.
That's what I did.
That's incredible. So from starting as a marine biologist, at least from an educational standpoint, to one of the top capital markets brokers in the country, in the state, if not the country. So you had mentioned that you first started leasing within real estate, and obviously now you do financing primarily of commercial real estate assets. So did you just fall into the leasing, and why the transition?
Yeah, I'll tell you, from my perspective, leasing was a wonderful way to start because you handled a lot of volume of transactions, both small and big. I was on a team where there were two leaders of the team. One was very much the inside guy, handled the transactions, handled all the follow-up calls, handled the lease negotiations. The other was the outside guy, and typically would be on the country club or on his boat and come back with 2 or 3 deals to work on. So I really got to see both sides of salesmanship and got both the technical training and the extrovert training, I would say. And that's what led to me having success as a leasing agent. And then ultimately, I represented the Daytran centers. They had gone through an REO and foreclosure. And
it's in Dadeland.
In Dadeland. And I represented a building 9700 South Dixie Highway, which I now have an ownership interest in 30 years later, and a number of other buildings around town. And what I found was a leasing career, at least for me, if you're representing buildings, you fill up the buildings, you work yourself out of a job. And you really create tremendous value for someone else. So while I appreciated the transaction and the learning, at some point I realized that there were bigger ways to earn fees within brokerage or within the universe of business. And I applied to law school thinking I was going to be a trial attorney because that's where the commissions, so to speak, are the largest. And I got a scholarship to UM, for the third time, but I had to be a full-time student and they wouldn't let me go at night. So I resigned from the position that I had. I have a brokerage license, so I formed my own firm at that point and brokered a few deals while I was in law school and realized the amount of money I was making brokering a few deals on the side was far in excess of what a first-year associate would make working really hard. That in part pushed me back into commercial real estate. And at that point, I realized that in a capital markets career, as a leasing guy, if you lease a building, you're conflicted from leasing a building across the street. As a capital markets guy, if you sell or finance a building, that's your calling card to sell or finance the building across the street. As a leasing guy, if you lease office buildings and your owner loves you but buys a building across the country, you're not going to fly to show 400 square feet of office space, right? But with an NOI and a calculator, I could finance that building. And then I tend to be a little entrepreneurial in my thought, and I don't like doing the same thing all the time. The capital markets allows me to work on different asset classes, work with different lender types, work on big deals, small deals, work through the process from a construction loan or an asset and development loan on a piece of land all the way through the permanent loan and to follow the loan through the cycle. So that's what I chose to do. And, it was a little bit of a naive business plan in 98, but there was something called CMBS, which was new then. And I realized in that moment in time that CMBS equalized the market. What I mean by that is if you were a big institution, you had access to life company capital. If you were smaller, you had access to bank capital with recourse. But CMBS was indifferent to recourse. They really looked at cash flow. And, I could take that program around the country, and I did. My first business was built mostly within the CMBS architecture until the great financial crisis became a little more difficult.
Yeah, and I want to get to the great financial crisis and kind of what you were doing and came out of that. But before that, how intentional was your thought of, hey, if I'm an office leasing broker, I lease myself out of a job because now the building's leased and, now I got to go find the new building. And if I'm leasing this building, I can't lease the one next door. So I'm also constraining myself in a way. How intentional was the switch to mortgage banking, capital markets, and saying, it seems like it's got more of a network effect, compounding effect, and things like that?
Yeah, so it was really pretty simple, at least for me, and maybe in my naivete. But as a young guy, I recognized I needed a life plan and a business plan, and just to have one wouldn't help me with the other. And so from a life plan, just starting out in Miami, I had nothing. My parents weren't in an industry where they could help me. I had no contacts, but I had desire to make a lot of money, right?
Yeah.
And that would allow me to have the things that ultimately would fulfill me and allow me to have a family life. And so I looked across the spectrum and saw that the capital markets was a place where the commissions tend to be larger, where if you align yourself with the right people and the right capital, you could do rapidity of transactions. In leasing, you tend to get paid half on execution of the lease and half on occupancy. Execution of the lease was in some way in your control. Occupancy was not. In the capital markets, you got paid at closing almost 100% of the time. And being in capital markets from the finance perspective, I come in at the end of the movie. So if a client is acquiring an asset or has a mortgage due, I knew that within 30 to 60 days, I was getting to failure or a payday. And that allowed me really to compress the cycle of time in which I could earn a fee. And, that naive business plan turned into a pretty good career.
It's a phenomenal career. So basically when a client calls you and says, in one example, I have a deal under contract, for you, you're like, okay, let me look at the contract. Within the next 60 or 90 days, they're closing on this asset.
Yeah, and then, markets ebb and flow as to where that's more or less a liquid answer.
Right.
But the ponderance of my career, that's been the case. And then every time I had success, either with that client or the broker selling a deal, that became my calling card for referrals and to build a bigger network.
Right. So I just want to hone in on this a little bit because it's funny, but you had mentioned to me that you were at one point walking into buildings with floor plans and like working down the building as leads. And I just kind of want to like give me the context because I feel like nowadays people just first year analysts come to an office and they're like, here's CoStar and all the information I ever need. And I'm just going to sit here and look at the computer.
In today's commercial brokerage world, you have a highly tactile approach to the business. Most of it's within a team network. You have a lot of tremendous resources, even if you're a sole practitioner in terms of CoStar and MLS and things of that nature. Pre-internet, but the computer was around when I got started. It was a lot different and you didn't have that level of sophistication. So my first job as an intern was to go and I would get from Miami-Dade County Records a building like the one we're in. And I would see how big the building was and I could eyeball the floor plate from there if it wasn't on that. And then sometimes the tenant information was there, many times it was not. And I would sneak in the building and I would look at the directory and try and eyeball the rent that a tenant was occupying. So it was a 20,000 square foot building and there were 2 tenants on the floor. You would guess that each was about 10,000 feet. If a building was built in 1987 and it was 1997, then you could say that it's a 10-year lease. They might be coming up for renewal.
Wow.
And so I would come back to Coldwell Banker and synthesize that into a form where the brokers of the day could then act on it and make phone calls and generate business from that. And I guess I had enough moxie to do it in enough ways that I generated significant leads for brokers, which translated into business for them and ultimately got me hired as the youngest broker at Coldwell Banker Commercial in their 100-year history. So that was in, I graduated, I guess, with my master's in 88, I believe, and I got hired at that
I was
time.
almost born by 88.
Yeah, there you go.
So out of curiosity, how long were you leasing before going to, was it like a year or a handful?
So I started in leasing in 85 as an intern and graduated. And by then I was fully employed, first as a runner working for senior brokers and then as a broker myself. And I left, I want to say in 89 from Coldwell Banker Commercial to take over a building. And I worked for a developer out of Houston named Barker Patronelli. USAA was our chief equity partner. And I did that until 94 when I went to law school.
Okay.
And I continued to broker leases and refer deals out until 98 when I finished law school, passed the bar,
so you spent
and got into capital markets.
10, 13 years leasing.
Yeah, I would say.
Like on and off, it wasn't like you were just leasing.
Yeah,
but...
and I had, I would say, sustainable success for about 5 years before I realized it was a business plan I didn't want for my life.
Right.
And I went back to law school to earn a degree and put myself in a different position in life. I wasn't necessarily sure where that was going to lead, but it led back to real estate and the capital markets.
Right. I was going to mention through the 08 crisis that you mentioned with CMBS and stuff like that. Were you then doing capital markets and kind of how was that?
Yeah, so I've been dedicated to the capital markets since 98. The great financial crisis in hindsight was a very interesting time because most of the deals that were getting foreclosed on were fundamentally good properties that just had a capital stack dislocation. And most of those deals, as they changed hands, interest rates were coming down. So the properties could perform better and they were being acquired at a lower basis with new equity. And that new equity tend to have more discipline, as did the capital markets, in terms of how much they could borrow. And so that allowed for rapidity of transactions, one being more successful than another. And that really caught the technology wave at the same time. So strong developers, owners, borrowers, and investors could really scale their business, whatever side of that spectrum they were on. And I built a team of 12 and we scaled right along with it. And so at that period of time, I had a serious business selling and financing office and industrial properties, having my roots in office leasing.
Yeah. Okay.
And then I built a separate finance business, which continues to what I do today.
Got it. And then at the time, because where I see when interest rates started increasing, April of 2022, in this sort of cycle that we're in, there's this void of transaction activity because of dislocation in the market. Was there a similar type of dislocation in '08, or was it just deals on the way up, deals on the way down?
So yeah, no, there was a similar type of dislocation in '08 for some period of time. I would say there was a period of time where every asset had zero value. If you wanted to sell your house for a penny and it was worth $1 million the year before, there was not a lender to give you a tenth of a penny in a loan. And credit meant nothing because there was such the capital market system itself was broken. So it was very hard to value anything. And so there weren't a lot of trades. But what interest rates coming down and the fundamentals of the real estate and the assets themselves being strong, that allowed for market money to come back to the market much quicker and to demonstrate success to the market.
Yeah.
So it was different than where we are now, where you have the cost of capital going up. And I feel like it's starting to settle down, as we talk about this in July of 24. But
I'm glad you timestamped it.
Well, because
the world can change tomorrow.
Because if we were talking about this in May of 24 and I made that statement, when the interview was over, I'd be completely right or wrong, right? Because the market was so volatile. And
it's so smart.
What I have seen for the last almost 24 months now is tremendous volatility, not only in the indexes and how they're rising, but in the amount of movement we've had. So in a given capital markets year, you may have, let's call it 10 business days, where the treasury moves more than 10 basis points in a single day. I think last year was close to 100 business days.
Wow, 10 times the volatility.
10 times the volatility and business days, not calendar days. So compress that to when people are actually working and engaged. That's almost the whole year. And that's why you see transaction activity had fallen as much as it is. Yeah. Now we're looking at, again, date stamping where we are in July of 24. We've got a big election coming up. Yeah. And that always affects real estate to some degree and transaction activity. And while we have interest rates, I believe, starting to solidify and potentially a rate cut coming, I feel the market's priced that in already. And we're looking at a calmer C, but we're plus or minus a 6% cost of capital, which historically, if you go back 40 years, again, in hindsight, I think 5 years hence, people look back and say the crazy time was the last 10 years, not the time where we're getting back to normal. Yeah. And that's not necessarily great for me and my loan career, but I believe it's a pretty accurate statement and economically makes sense.
Yeah. Why the comment that it's not as great for your loan career?
Well, you look pretty smart when you're doing permanent loans at 2.5% and 3%, and then to go back to those same clients 3 or 4 or 5 years later, if their loans are coming due, or they've added value and want to refinance, and now they're going to go up to a cost of capital around 6%. It's a lot more difficult to convince somebody.
Well, in my business, right, it's also we were selling deals at a 4%, 3% cap rate, and now we're selling deals at a 5.5%, 6% cap rate. And same thing, it's like we sold some deals for, call it $120 million, that today they might be worth 100, but like the person doesn't have to necessarily transact. But when we go and price the asset, it's like interest rates have gone up and that's affected asset valuations.
And we sit in Florida, which, look, I discovered it in '83 as the place I want to live the rest of my life. But during COVID, it seems like the rest of the world discovered it as well. And so we have fundamentals here that have always been strong and are just starting to compound upon themselves into how strong they're going to get. Yeah. And that creates a different type of volatility. That's positive because most of your sellers are looking in the future and saying, you know what, I think this income is going to go up another 10, 20% over time. Yeah. And so your buyers have to be equally as convinced and get the capital to back them up in order to make those trade decisions.
Yeah. So let's talk about Miami and Florida because you've been here since the 80s, right? When you see what's happening right now, do you think because historically we've been sort of this boom and bust market, as so people say. Do you see what we're seeing now as, hey, it's different, it's deeper, or do you think we're at some sort of ceiling? Kind of what's your gauge?
Yes, I would tell you, and some of the folks that mentored me in the business are still around, and I had this conversation maybe a year ago, and I commented that I've seen more change in the last 3 years than in the 60 years that gentleman had been in the business.
Wow.
And they agreed. And so I would tell you this, every cycle is the same in some ways and different in others. And what I believe is different this time is that the Southeast generally, Florida more specifically, and South Florida very specifically, is seeing not only immigration of wealth and immigration of people, but immigration of careers and jobs. Mm-hmm. And what I mean by that is it was always the case that someone was very successful and maybe had a second or third home in South Florida. And when they were here, they spent a lot.
Right.
And that wealth exhaustion without the creation was great for our economy, but it's nowhere near as good as when that group comes down with their firm and creates 10,000 jobs or 500 jobs or 50 jobs. And so when I look at my kids, and my son has just graduated Tulane, my daughter's about to go off to Emory,
Congrats.
I'm excited that they're going to come back to South Florida, not just to be with their dad, but there's real sustainable career opportunities for them and multiple. And you go back 10 years in the capital markets, there were maybe 3 people like me in the industry. And starting with Berkadia, who recruited me from a position I had been in for decades, all the major firms are down here, and there's multiple providers of services, and that translates through all the business lines and all the career lines.
Right.
The law firm's much more competitive. A lot of big firms that weren't here before are now established.
Kirkland and Ellis and a bunch of big
you can just run down the list.
Yeah. So for me, it's funny, like my girlfriend, she works at Visa, right? And she went to Columbia and is like, has a great pedigree and resume. And I'm just like, those Columbia, Harvard graduates Miami was not a primary destination, right? Whether because it didn't have the jobs or because, the jobs were in New York, Boston, whatever it may be, is one thing, to your point. And then the second thing is, especially with Berkadia's Knight Frank partnership, which gives us more exposure to like the global world, if you will. Now we're receiving calls from family offices in like Turkey, Malaysia, Poland, and all these things.
Yeah, you and I had that meeting with the Singaporeans a month ago.
Exactly.
That type of wealth may have owned a condo on the beach here,
right,
but was generally not interested in owning commercial real estate here directly. It may have come through an advisor or a big fund, and certainly they weren't looking at bringing employment here. And that dynamic has changed, and I believe that'll continue to evolve. Yeah.
Yeah. And to your point, for me, I remember I was talking to a Knight Frank gentleman, and he said, for the first time in my life, and same him, he's been at Knight Frank for 30, 40 years. He's like, for the first time in my life, I had somebody say, do I buy real estate in London or in Miami? He says that typically you hear London in New York or like London in California. And he's like, he even questioned the person, was like, what do you mean London or Miami? And he's like, yeah, Miami is where everyone wants to be. And this was like some old money, multiple generational wealth. And I'm like,
look, I agree. And, I love to travel, and I've traveled quite a bit in the last 7 or 8 years. And you say you're from the United States and people may or may not raise their eyebrows. You say you're from Miami and they want to talk to you. It's like its own country. And that's the same as if you're in a business meeting or if it's the Uber driver taking
people light up. Yeah, I remember my first Euro trip, like 10 years ago, I was telling them from Miami, and people are like, Miami? Like, that's just whether you're in Germany or Spain, wherever, they're like, whoa, like, cool. And I'm like, yeah.
Everybody has an opinion of South Florida. So
yeah. And I think it's true. So for me, I'll give you just another anecdote because I think the anecdotes are interesting, right? Because we see them in real time. I had a breakfast this morning with a gentleman that's doing business with Adam Newman, and he was basically saying, like, I used to be in Nashville, and we did a deal with his firm. His firm did a deal in Miami, and he was coming to Miami for that deal. And every time he was here, he was like, I want to make Miami my home. Like, I don't want to be in Nashville anymore. And again, I fortunately was having breakfast with him and met him. And I'm just like, it's crazy that you go visit this place. And it's just so compelling, I guess, for him that he's just like, I want this to be my life, not wherever I was. And especially now with like remote work and things like that, I think people don't have to necessarily be somewhere for a job. They have a little more flexibility, and that's changing, right? More people are hybrid and going back to the office. But I think it gives the competitive edge, right, to Miami in an interesting way.
So look, we talked about the great financial crisis and the current downturn, but the first crisis where I came into the business was the S&L crisis.
The savings and loans crisis.
And during that period of time, when I was leasing a building that was in REO, and then ultimately when I took over the Daytran centers, Class A office space, brand new, $17 to $50 a foot, full service, 6 months free rent on a 5-year lease, moving expenses and an allowance for furniture included, and it was hard to get the tenants to come here. Now we have a dearth of new buildings, and we have few buildings like the one we're in where they've done a phenomenal job keeping it contemporary.
Right.
And you're getting $150 triple net rents in some of the buildings we're underwriting. It's amazing. It's hard to believe that, and it's sustainable, and it's from new to market firms that are demanding best in class office space, because that's where they had before, whether it was in Chicago or California or New York in many cases here. So
it's now elevating kind of where Miami, if you look at 830 Brickell, if you look at, I don't know what it's called, but the office that they're doing in Sunset Harbor where the... 18 Sunset, yeah. That one, it's like, I think they're getting $100+ rents as well.
Yeah, and any of the boutique buildings, that leased up in Coconut Grove, by example, were pre and during the pandemic. If that space came back to market today, it'd be double.
Yeah.
And there's more demand for it than there is tenants to take its place. If you have a well-executed commercial building, there are tenants excited to be in it.
Are you seeing, because you do deals across multiple states, right? Like for me, I'm just sort of selling land and selling multifamily in South Florida. But for you, are you seeing, I'm sure you're seeing a lot of interesting trends, but like, are clients saying, I want to sell in this state and buy in this state? Is financing easier in South Florida or Florida than it is in, name what other state you do business in?
Yeah, I would say that every opportunity has its own benefits and burdens. And so, for states that people are perhaps exodusing at the moment, that's going to drive down basis, which is going to create a new set of opportunities. And, you have to look at each case specifically. I would say as a more general statement, the Southeast as a whole has been a very friendly climate to do business, both by temperature and by administration. And generally speaking, compared to some of the older, more infill areas of our country, you have a higher quality of life or lower cost of living, even as the cost of living has continued to accelerate. Maybe excepting Miami, where the cost of living is really accelerated. But in the rest of Florida, land is generally cheaper. The cost to construct is generally cheaper. The scale of housing is generally better. And you can offer more to people than they were getting somewhere else. That's very attractive. And companies have recognized that. And then, you have all these new technologies. So like in the Southeast, I've done some industrial financing in the Carolinas. And, 20 years ago, you didn't have credit tenants, but now you've got the auto industry there, and you've got all these EV startups and backed by credit or credit-esque investors. And that's creating a whole new opportunity. You look in the Midwest, and that's starting to occur too. I drive a Rivian that came from Normal, Illinois. They bought an abandoned Mitsubishi factory and resurrected that. And so to the extent that company does well and survive, that's going to create an additional opportunity. They're looking at doing a big plant in Atlanta. Tesla and X is moving multiple divisions to
they just
Texas.
Announced they're moving another.
Right? So, that's shifting. I don't think one happens at the expense of another. California still has the 6th largest GNP in the world if it were by itself as a country. There's a lot of appeal there, but it is a much more difficult place to do any kind of business.
Right.
If you take a look at Brightline and what we've done in Florida as a state and really created connectivity with the public-private partnership over a 5-year period, and then you compare that to the billions of dollars that have been spent in California to build about 6 inches of rail that doesn't work, it's very different. And corporate America notices that, and internationally, corporations that want to be in the U.S. notice that.
I almost take for granted how good things are and work in Florida. And it hasn't actually been until recently where I've had and gotten to know clients from California and stuff where they tell me like, I've been permitting this building, or I've been waiting for this thing for 3, 4, 5 years, or like we spent, I don't know how many hundreds of millions of dollars to build this affordable thing, or like the government, right? To build something in California. And I'm like, no, in Florida, like people want you to do business, want you to come here, like open our arms for it. And I thought that was everywhere.
We still have zoning and we still have a process,
right?
But generally speaking, it's a friendlier state, and we don't have the level of taxation on the individual. So someone moving here can essentially make the same money and get a big raise, or make less money and feel like they're making the same.
Yeah.
And the cost of living is lower outside of Dade County.
Yeah, and as it relates to your capital markets career, I kind of want to go into like sort of like the early big wins you had. But if you can take a second and sort of explain what it is that you do as like a mortgage banker or capital markets broker.
Sure. So, one day I was trying to explain that question to my daughter, who was 5 or 6 at the time. And I said, I make big loans on big buildings. Yeah. And she kind of got that, and it resonated with me. And so what I do in a more descriptive sense is I provide capital solutions to owners and investors of real estate. So if someone's buying a piece of land and has a vision, if their vision is provable, I can bring the capital together, debt, mezzanine, equity, construction loan. If someone's buying a broken asset, beautiful office building, and the major tenant goes bankrupt, so now you have this big hole. It's not the building's fault. I could provide in most markets the type of capital that will allow for the acquisition of the property, leasing of that space, paying the tenant commissions and leasing commissions, the build outs, and then paying even an interest reserve to carry the building until it can carry itself.
Right.
And then if someone's buying a building for cash flow or created that value, we can do a permanent loan. And as opposed to being a banker working for a bank and having one source of capital, I'm more of an investment banker of real estate, and I have an infinite source of capital. And so I can find the source that most benefits my client, whether that's commercial or residential. And then specific to Berkadia, we're among the top lenders every year in Freddie Mac, Fannie Mae, and FHA. Yeah. We also have our own balance sheet capital as well. And because of the way that we're held as a privately held company and a servicer, we hold all the servicing that we originate loans for our clients. We have many special relationships known as correspondent relationships in the industry, where life companies, CMBS, and even some banks will rely on us to monitor the loan once the loan closes. And our clients find that very useful, because if there's an issue with something, taxes go up, or the escrow changes, or they have a casualty at the property, or they need some help, they can call me during the life of the loan, and I can work with their servicing department to effect solution within the guidelines that are provided. And it's been a great resource for our clients.
Yeah, and I mean, a big reason, because I was at a competing brokerage shop before I came to Berkadia as well, like a big reason for me coming to Berkadia was having people like yourself on the mortgage banking and capital markets team that I could lean on. Because for me, it's like when I'm selling a building for $100 million, that buyer is going to go and need a $65 million loan. And I'm like, well, you should talk to Charles, because he's the one that is talking to all these banks or agencies to get that loan. And I guess, why would a lot of these clients who have direct relationships and stuff like that go and say, I want to hire Charles to find me that loan, even though I've done, I know the banks myself, or whatever it might be?
Even a substantial owner of real estate in a typical year does less loans than I do. And because I'm in all the asset classes and work with a lot of different sources of capital, I may spot opportunity or see changes in the market before they do. And as markets ebb and flow and lenders ebb and flow, particularly with banks, they're being heavily regulated right now. And so many banks, even relationship-oriented banks, will make a loan to a borrower predicated on how much money that borrower has with the bank. So in essence, they're almost making a loan to themselves, right? Prior to CMBS, a lot of smaller and mid-sized borrowers or owners of large older assets, they were all bank borrowers. That tended to be recourse financing. Life companies are non-recourse. Debt funds are non-recourse. CMBS is non-recourse. Freddie, Fannie, FHA is non-recourse. So God forbid there's ever a problem with the asset, so long as you don't commit a fraud or file for bankruptcy or cause environmental waste, you hand back the keys and say, I tried my best. Right. And so that's very appealing to a borrower that in a recourse context could lose everything. Beyond just the asset, the wealth they've brought and created in other areas and nothing to do with the property could be heavily impacted.
Can you give me an example when you say, I can spot changes from a source of capital that can be accretive to my client? And you don't have to name any banks or any, source of capital specifically, what's something that changes?
We just talked about banks.
Yeah.
So banks got curtailed in leverage. They got curtailed in how they made a loan, and they needed deposits to make the loan. And debt funds show up and they don't need deposits. They look at the future value of the building. They can lend at higher leverage. They can lend in a non-recourse world. And depending on how the loan is articulated, they may actually have a lower rate. So all those things are superior.
Right.
In the multifamily context, generally speaking, Freddie, Fannie, and FHA are the best lenders all the time, except when they're not. Sometimes they hit their caps. Sometimes they get a little shy. Freddie Mac has had a lot of new regulation that's come in, and life companies have shown up to do and handle assets different. Freddie Mac generally and Fannie Mae looks at a 90-90. They look 90 days backwards to come up with a valuation. Life companies can many times lean forward and look at market as it's improving and give credit based on the equity that a borrower is putting into the asset. I had a loan earlier in the year that we wound up winning with a life company, but a CMBS lender showed up and in Florida was pricing a 120 debt service coverage to an interest only constant. The rest of the market was pricing to an amortizing constant. So that interest only constant, albeit cost a little more in rate, but allowed me to unleash a lot more proceeds. And that caused the life company to get more competitive. And so we wound up, a life company can lock rate at application. Most other lenders lock rate closer to the end of the loan.
Right.
So if you have an opportunistic week like this week where rates fell and spreads tightened, if you were under application with a life company, lock rate right away, and you put that deal to bed. Like life companies closing the loan.
If that rate goes down after application, do you get the benefit of that or not really?
So if you rate lock, you rate lock. And that's a bilateral contract, and you should you make your bed and you lie.
You should be happy with where you locked.
Yeah. And then, when the market's highly volatile, some people like to lock rate and just not think about it again.
Yeah.
Some people like to play the market and hope that it dips down at some point during the process and they can lock rate opportunistically.
Right.
I get paid to execute, not to judge. So I have clients in both camps.
Yeah.
Personally, I like to close down as many variables and just stick with constants. So if I could lock rate with early and know that deal's going to work, I won't worry about it if it's going up or down.
Yeah. So, in short, it's like because the capital markets is always in flux and the sources of capital and what they need, especially in this environment, people are like, hey, instead of me going to this 1, 2, 3, 4 relationships I have, someone like Charles knows 50 of these guys, 100 of these guys, and he understands.
And I will, in that same period of time, I will run a process.
Yeah.
And I'll have an alpha and omega, and we'll start and finish. And that keeps every other lender focused on that time frame. And so no one's resting on their laurels of a previous relationship. And so many times that same relationship with that borrower will get better as a result of that process. And other times we find lenders that are much better, and I'll create a new relationship.
Right.
And then sometimes I serve as an insurance policy for the lender that they already had to make sure that when they go to their loan committees or their investors as owners, that they say, hey, we ran a process and our relationship with Bank X is still special.
So when you were in the business and you're sort of going all in the mortgage banking and capital market space, what were some big breaks that you feel like you've got in your career that really elevated or accelerated your trajectory?
So when I graduated law school, a client that I had worked with when I was a leasing broker referred me to a small mortgage bank that was no longer in business, and they were correspondents. So the old model was you represented 7 or 8 life companies, and a borrower would say, well, what life companies do you represent? And they would hire you for those 7 or 8 and hire the next guy for his 4 or 5. And then they'd pick a lender. I didn't necessarily like that, but I was working on a loan modification for that same client. And someone called me and said, hey, I'm moving to what was then CBRE. And I said, oh, really? You're changing? He goes, no, our company just sold. And I'm now working for LJ Melody, which was became a division of CBRE. And they're looking for someone to open the Miami office. Would you be interested? And I thought, wow, that's really cool. And I said, yeah, I'd be very interested. And, after a period of recruitment, I got hired. And what I was told then is, look, the Miami office has 0 correspondence. And we've had a hard time recruiting for that position. So we just need you to do 1 or 2 deals a year to keep your lights on for the firm, because the firm needed to be licensed in Florida. And I thought, well, that worked great for the firm. That didn't work for me. I need to do more than 1 or 2 deals. And so I thought about my past career as leasing. And in leasing, one of the advantages is, at least for me, what I thought was an advantage is you're always doing deals with someone else. It's almost residential in that regard, because there's someone that represents the building and then there's someone that represents the tenant. And I thought from a capital markets career, that's not the way things are done, but there are plenty of brokers that I know really well that have relationships. And if I could access those relationships through them, it'd be a warm call, not a cold call, and I could do more than 1 or 2 deals in a year.
Yeah.
And so I remember we talked about breaks. The first break wasn't so great, but I had been at the firm about 3 months. I think they hired me in September of 98, and I went to the MBA, which is a big mortgage banking convention. Yeah. They had their offices listed in terms of top office to bottom, and Miami was dead last, and then there was a little asterisk that said started 4th quarter. And so I did not like that. And then my second year in the business, unfortunately, corresponded with 9/11. And so every deal I had under application fell out. Oh, wow. But I knew that was not a reflection of me and my effort or the firm that I was with or the lenders that I were getting to know. And I saw that I could be successful. And so by the 3rd year, I had put most of those deals back together, plus the new deals that we had done. And when I went to the MBA, the number 1 office in the country was Miami. And that's a little bit jaded statistic because I was sitting in Cube and, the old line mortgage banking office was quite opulent. You had country club memberships and some of those kind of things because you had to entertain the correspondence. I didn't have any of that. And so my only expense was my allocated Cube cost within the brokerage firm. And so by the 3rd year, they had to change the rules because I was consistently getting to be but by then I was also one of the top guys in the firm, and it was a great period of time to start my career. And my first big break from a deal perspective, I would say, came in 2s. I closed 800 Brickell, which was then a $24 million loan, and it made big headline news. And it was a loan on Brickell Avenue, which was...
Is this one the Kaseya Center now? Or not the Kaseya Center, but this is one that has a Kaseya...
It's on the corner. It's a dark building. It's owned by Gadsby. Who we've actually done some loans for as well.
So wait, you refinanced that building?
That loan was acquired by three private families, and I did the loan through my relationship with the leasing broker for them.
And how much was the loan?
The loan was $24 million. So that was my first tombstone, but it was enough of a loan to pay the broker that introduced me to the deal, take me off draw, get me on my way. And I had come back from my honeymoon, and that was
amazing. You were like, big win.
I was lit. And then my second big loan was 230 Peachtree in Atlanta. And, then that sort of put me on the map regionally. And then I was just up and running. And, I can't say it's been a nonstop party ever since, but it's been a good career and a lot of hard work.
And what are some of the bigger, because again, so you started with this, you had this $24 million loan, which is like a big thing in your career at the time. Now, what are not now during this market cycle, but what have been some of the bigger loans that you've closed and deals that you've done? And I guess Miami would probably be ideal if...
But just the ones that resonate in my head. In Florida, I've done the B of A Tower in Jacksonville multiple times, and I've seen the values change there. I've actually done every high-rise in Jacksonville at least once, some twice. I did a large portfolio. This building that we're in is owned by Parkway Properties, but in the previous entity, Jim Houston, who's been an incredible client, a wonderful guy, very good acumen. He acquired a portfolio of properties about $250 million. And we did that whole portfolio for him. And that was a complicated deal, a lot of transactions, tight time pressure. I put a team together to do it, and then we excluded land collateral, which he later sold separately, which was a neat trick I learned from Jim. He does quite often. Let's see, since I've been at Berkadia, more recently, we just closed an $86 million loan called the Julia, which is a cutting edge building. We also did the construction loan there. It's exciting when I get to do construction loans and help communities emerge. About to close a deal over $100 million, again, where we did the construction loan, and then we're now doing the transitional bridge loan to aid the lease up. And that's in an area of Miami that didn't exist 5 years ago from an institutional perspective. I could run down the list.
Yeah, there's a lot, but it's incredible.
There's a lot, but
for me too,
fun.
It gives you a sense of community, especially for us in South Florida when you're driving by and you can look at a building and be like, I remember working on this. I remember helping getting a construction loan to build this thing. And
my kids get bored on the road trips because I keep pointing those things out. So.
They're like, we know that you did something with this. So actually, on the note of community, you've done a lot with the University of Miami. And I guess kind of walk us through. So most people, right, go to a university, in this case, let's say University of Miami, then they graduate and they say sort of thank you and go on their way. What has led you to sort of, keep either helping or going back? And I guess just talk to us about some of your experience with them.
Yeah, so, and I guess because I was a kid that didn't want to go to college, while I was in school, I started to appreciate the benefits, which is not always reflective of some of my own kids. And I guess they're more like me. Yeah. But, by the time I switched majors and then went into the School of Business and then got my first internship which led to almost 30 years in and around the same company, and led to 2 careers where I had strong success. I realized it wasn't just me. It was what I learned. It was the ability to create teams that made me bigger than myself. And so, I felt the desire to pay that forward. Yeah. And so I've been a mentor at the university off and on for a long time. And I've had students go off and do great things. And, as that went on, I got a little bit more active with the University of Miami. I was asked to be on the real estate board for the MRAD program, which I'm on. I'm on the Citizens Board. Okay. I have been asked to be on a Changemakers Committee through the Citizens Board, which helps allocate funds to students to do projects, with some of the money that we raise. And then I guess coming full circle, I went to undergrad, grad, and law all on scholarship. Oh. And I funded a scholarship last year in perpetuity. And that kind of, for me, it was a way to come home and give back to the university what they gave to me.
That's incredible. So when you fund the scholarship, that's what you give a donation that then helps other people with scholarships into that?
In just brief form, and the people that do tens of multiples of what I could do, but it's a amount of money that creates a return on capital, and that return on capital provides a scholarship in perpetuity. Got it.
That's incredible.
Yeah.
What do you think, I guess, keeps you going as it relates to doing more deals, meeting more clients, giving back to the school? Because I think a majority of the people that get a lot of success and make, a good amount of money, kind of start settling down and
I guess I had great mentors coming into the business, and you asked me about the university. So Mike Klotz, who was the outside guy when I learned the business, always taught me to, be the best guy in real estate at the places that are things you love to do. So, the university was something I love, and I spend time there, and I'm happy to give back there and be known for what I do in the business world there. But I wouldn't necessarily want to do that in, some organization that didn't appeal to me. I didn't want to pander to that. I want to try to be genuine self. And that's kind of always guided me. I love the business. I love the complexities that my clients come up with in solving those problems. I find that very invigorating. It's allowed me, I've done deals in 27 states. I've traveled to 41 of them. And so, it's put me in an arena that I wouldn't have been in as a regular guy, not doing what I do.
Yeah.
And the interaction with, folks like you, where I have an opportunity to mentor and my story becomes part of your story.
Absolutely.
Is great. And, it's a relative world. And I learned that early in the business from Arnold, who was the inside guy on the team that I started with. And, he always told me to spend my money 3 years behind because I could outlive any downturn.
That's a really good one.
And, we're in a business where people spend their money 5 years ahead. And that's not necessarily the way where I wanted to live. And over the course of your life, if you're disciplined in your business practices and in your investments, at some point, the investments can overwhelm as much as you could earn in the business. And that's very rewarding, especially in downturns. And, the opportunity to solve problems for people is great. I try and stay fit, but I'm not an athlete. But to compete in the national stage in some of these giant transactions I've been fortunate to be involved with, and to work with a firm like Berkadia and the colleagues that I have around the country is a pretty singular environment. It's very hard to recreate in another industry, I think.
No, again, you were a big part of the reason why I joined Berkadia, having peers and mentors like yourself. And for me, from a selling perspective, right, and I know we did this on a transaction recently where it's like, hey, you can hire Omar and the team to help sell your building while Charles is looking to refinance your building. Omar will bring offers to sell the building, and then Charles will bring offers to refinance the building, and you can decide what it is best for you and your investors.
Or we can finance the buyer.
Right.
So we give a lot of transparency to the transaction when we can work collaboratively, and we give a lot of certainty to a transaction. Commercial real estate is not necessarily a philanthropic business, and you want to make sure that you're working on quality business that gets to a payday within a relevant amount of time.
Yeah, absolutely. So I guess someone listening to this, right, to kind of sort of closing remarks, someone listening to this hears you as inspired and wants to be Charles Foschini in the future. What advice do you have when they're entering the business, or what advice did you get early on that you think made a difference?
If they want to be me, I would tell them to aim higher. And if they want to get into the business,
that's good.
I would suggest that they find the strongest team they can within the business, and to associate themselves with folks smarter and better than them, because they'll learn the fastest, they'll see the most deal flow and have the most transaction success and opportunity, and that'll allow them not only to grow if they're good at it, but really to assess if they want to do it. Because it is a very, very tough business. And when the business downturns, it can be a very cruel business as well. We don't get paid to practice. We get paid to close. And you really have to have the ability to sustain yourself in up and down cycles.
Couldn't agree more. And if I look at my career and the luck and fortune I've had, it's a lot because of the things that you just mentioned, of looking to work in the best teams, have the best mentors, learn from them, draft off them. So Charles, I can't thank you enough for the time.
You're welcome. Thank you.